Welcome back to Financial Podcast, your go-to source for in-depth analysis of the economic currents shaping our world. Today, we're diving deep into a topic that has captured headlines and ignited a fiery debate between political power and monetary policy: the persistent tension surrounding interest rates, especially in the wake of recent jobs data. It's a complex interplay, but one that is crucial for understanding the economic landscape we navigate. President Trump has once again escalated his calls for the Federal Reserve, specifically its chair, Jerome Powell, to lower interest rates. This renewed pressure comes on the heels of new data revealing a significant slowdown in hiring across the United States. It's a narrative we've heard before, but the latest figures add new urgency and a fresh round of political commentary to the long-standing discussion about the Fed's independence and its role in steering the economy. The catalyst for this most recent outcry was the ADP National Employment Report, released just a few days ago, which painted a rather dismal picture of the labor market in May. According to the report, private employers managed to add a mere 37,000 jobs during the month. This figure was a stark contrast to expectations of economists who had largely predicted a gain closer to 110,000 jobs. To put this into perspective, it marks the smallest increase that ADP has recorded since March of 2023, signaling a noticeable deceleration in the pace of hiring. Such a significant miss in job growth naturally sent ripples through financial circles and quickly drew the attention of those advocating for a more accommodative monetary policy. The immediate reaction from President Trump, conveyed through his social media platform, was an emphatic demand for the Federal Reserve, specifically his chair, Jerome Powell, to lower the rate. He expressed a strong sense of urgency, implying that any further delay by Chair Powell would be too late, and even highlighted that European central banks have already moved to cut rates multiple times. Delving deeper into the ADP report offers a granular view of where the labor market is feeling the most pressure. While overall hiring slowed considerably, some sectors did manage to eke out gains. Leisure and hospitality, along with financial sectors, were noted as the primary contributors to the newly added jobs in May. This suggests that certain service-oriented parts of the economy are still generating employment, albeit not enough to offset broader weaknesses. However, the picture wasn't universally positive. The manufacturing sector, an area that has been a particular focus of various economic policies, unfortunately saw a loss of 3,000 jobs. This decline in manufacturing is noteworthy, especially given ongoing efforts to stimulate domestic production. More broadly, goods-producing industries experienced a net loss of jobs, even with some gains in construction. Meanwhile, within the service industries, despite strong performances in leisure and hospitality and financial activities, there were notable job losses in professional and business services, education and health, and trade, transportation, and utilities. Furthermore, the report offered insights into the size of firms experiencing job changes. Small firms, those employing fewer than 50 individuals, actually saw a contraction in employment, losing 13,000 positions. Even large companies with over 500 staffers reported a modest decline. It was primarily mid-size establishments that contributed to the gains, adding 49,000 jobs. This mixed performance across different firm sizes and sectors paints a complex and somewhat uneven landscape for the labor market. President Trump's consistent push for lower interest rates is hardly a new phenomenon. He has long held the belief that the Federal Reserve's benchmark rates are too high and are hindering economic growth, placing the U.S. at a disadvantage compared to other global economies. He has openly expressed his frustration with Chair Powell, even coining the nickname "too late" to criticize the Fed's perceived sluggishness in adjusting rates. This strong opinion has led to direct confrontations, including a face-to-face meeting at the White House where the president made his case for rate cuts. However, the Federal Reserve operates with a mandate for independence, a principle that Chair Powell has consistently upheld. He has made it abundantly clear that the Fed's decisions on monetary policy are rooted in objective economic information and what is deemed best for the overall economy, rather than being influenced by political pressures. This stance underscores the traditional role of a central bank, which is to maintain price stability and maximum employment, often requiring it to make unpopular decisions that are seen as necessary for long-term economic health. A significant factor complicating the Fed's decision-making process is the impact of trade policies, particularly the sweeping tariffs that have been a hallmark of the previous administration. Chair Powell and his colleagues have openly stated that the effects of these tariffs on inflation and the broader economy are uncertain. They have adopted a cautious approach, waiting to observe how these trade barriers translate into real economic consequences before making any adjustments to interest rates. The concern is that tariffs could potentially lead to higher inflation, a slowdown in economic growth, and even an increase in unemployment, creating a challenging environment for monetary policy. It's also important to contextualize the ADP report within the broader framework of jobs data. Many economists tend to view the ADP figure with a degree of skepticism as a sole predictor for the Labor Department's more comprehensive and closely watched jobs report, which includes both public and private sector gains. The Labor Department's data, which often released a few days after ADP's, is compiled using different methodologies and typically offers a fuller picture. While the ADP report showed a significant slowdown, the upcoming Labor Department report is generally expected to show a more respectable, though still decelerated, job gain. This divergence highlights the nuances in interpreting economic indicators and the importance of looking at a range of data points. Beyond the immediate jobs numbers, there are broader concerns about the health of the labor market. The Labor Department's April report, for instance, indicated that the number of Americans who have been out of work for 6 months or longer reached 1.7 million, the highest in more than 2 years. This long-term unemployment figure is a critical indicator of economic distress, as it suggests a persistent challenge for a significant portion of the workforce to find reemployment, even as the overall unemployment rate remains relatively stable. Such details add layers of complexity to the seemingly straightforward debate about interest rates. Despite the intense public pressure, the Federal Reserve's Federal Open Market Committee, or FOMC, has maintained its benchmark short-term rate at a range of 4.25% to 4.5% for its third consecutive meeting. The general expectation among financial analysts is that the Fed is likely to hold rates steady at its upcoming meeting, scheduled for June 17th and 18th. This cautious approach reflects the Fed's need to see sustained evidence of economic trends, rather than reacting to single data points, especially given their stated requirement for multiple poor readings before altering their interest rate decisions. The relationship between President Trump and Chair Powell has been tumultuous since Powell's nomination. While Trump elevated Powell to the Fed chairmanship during his first term, their views on monetary policy quickly diverged. Despite previous hints and discussions about firing Powell, the president stated in April that he had no intention of doing so. However, the question of whether a president even has the legal authority to fire a Fed chair remains a point of contention. Some Supreme Court justices have suggested that the Federal Reserve, being a uniquely structured, quasi-private entity, might be distinct from other independent agencies, implying limitations on such executive power. This legal ambiguity further underscores the importance of the Fed's institutional independence. Comparing the U.S. monetary policy stance with that of other major economies provides an interesting contrast. As President Trump frequently points out, central banks in Europe have indeed moved to lower interest rates multiple times. The European Central Bank, for instance, is widely expected to implement another rate cut, marking its 8th such reduction since last June. This move in Europe is largely driven by easing inflation and tepid economic growth within the Eurozone, creating conditions that are more conducive to aggressive rate cuts. This divergence highlights how different economic conditions and policy frameworks can lead to varied monetary responses across the globe. The overall economic outlook is characterized by increased uncertainty, with a heightened risk of what economists refer to as stagflation, a portmanteau of stagnation and inflation. This risk is amplified by geopolitical factors and the impact of tariffs, which can simultaneously dampen economic growth and push up prices. Chair Powell has articulated these concerns, noting that trade barriers could generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. This highlights the tightrope the Fed must walk,
balancing the need to support employment with the imperative to control inflation, all while navigating external pressures like trade policy.
In conclusion, the debate over interest rates, fueled by recent jobs data and political pressure, is a microcosm of the broader challenges facing the U.S. economy. The Federal Reserve, under Chair Powell, remains committed to its data-driven approach, resisting calls for immediate rate cuts while carefully assessing the long-term impact of economic factors, including trade policies. The divergence in economic performance across sectors, the distinction between different jobs reports, and the unique position of the Fed as an independent body all contribute to a complex picture. As we move forward, market watchers will be keenly focused on upcoming economic data, particularly the Labor Department's detailed jobs report and any further statements from the Federal Reserve, to gauge the likely trajectory of monetary policy. The balancing act between political expectations and economic realities continues, and it is a fascinating, if sometimes contentious, process to observe. Thank you for tuning in to Financial Podcast. We appreciate your continued support and look forward to bringing you more in-depth analyses of the financial world. Until next time, stay informed and stay vigilant. Welcome back to Financial Podcast, your go-to source for in-depth analysis of the economic currents shaping our world. Today, we're diving deep into a topic that has captured headlines and ignited a fiery debate between political power and monetary policy: the persistent tension surrounding interest rates, especially in the wake of recent jobs data. It's a complex interplay, but one that is crucial for understanding the economic landscape we navigate. President Trump has once again escalated his calls for the Federal Reserve, specifically its chair, Jerome Powell, to lower interest rates. This renewed pressure comes on the heels of new data revealing a significant slowdown in hiring across the United States. It's a narrative we've heard before, but the latest figures add a new urgency and a fresh round of political commentary to the long-standing discussion about the Fed's independence and its role in steering the economy. The catalyst for this most recent outcry was the ADP National Employment Report, released just a few days ago, which painted a rather dismal picture of the labor market in May. According to the report, private employers managed to add a mere 37,000 jobs during the month. This figure was a stark contrast to the expectations of economists, who had largely predicted a gain closer to 110,000. To put this into perspective, it marks the smallest increase that ADP has recorded since March of 2023, signaling a noticeable deceleration in the pace of hiring. Such a significant miss in job growth naturally sent ripples through financial circles and quickly drew the attention of those advocating for a more accommodative monetary policy. The immediate reaction from President Trump, conveyed through his social media platform, was an emphatic demand for the Federal Reserve to lower the rate. He expressed a strong sense of urgency, implying that any further delay by Chair Powell would be too late, and even highlighted that European central banks have already moved to cut rates multiple times.
Delving deeper into the ADP report offers a granular view of where the labor market is feeling the most pressure. While overall hiring slowed considerably, some sectors did manage to eke out gains. Leisure and hospitality, along with financial sectors, were noted as the primary contributors to the newly added jobs in May. This suggests that certain service-oriented parts of the economy are still generating employment, albeit not enough to offset broader weaknesses. However, the picture wasn't universally positive. The manufacturing sector, an area that has been a particular focus of various economic policies, unfortunately saw a loss of 3,000 jobs. This decline in manufacturing is noteworthy, especially given ongoing efforts to stimulate domestic production. More broadly, goods-producing industries experienced a net loss of jobs, even with some gains in construction. Meanwhile, within the service industries, despite strong performances in leisure and hospitality and financial activities, there were notable job losses in professional and business services, education and health, and trade, transportation, and utilities. Furthermore, the report offered insights into the size of firms experiencing job changes. Small firms, those employing fewer than 50 individuals, actually saw a contraction in employment, losing 13,000 positions. Even large companies with over 500 staffers reported a modest decline. It was primarily mid-size establishments that contributed to the gains, adding 49,000 jobs. This mixed performance across different firm sizes and sectors paints a complex and somewhat uneven landscape for the labor market. President Trump's consistent push for lower interest rates is hardly a new phenomenon. He has long held the belief that the Federal Reserve's benchmark rates are too high and are hindering economic growth, placing the U.S. at a disadvantage compared to other global economies. He has openly expressed his frustration with Chair Powell, even coining the nickname "too late" to criticize the Fed's perceived sluggishness in adjusting rates. The strong opinion has led to direct confrontations, including a face-to-face meeting at the White House where the president made his case for rate cuts. However, the Federal Reserve operates with a mandate for independence, a principle that Chair Powell has consistently upheld. He has made it abundantly clear that the Fed's decisions on monetary policy are rooted in objective economic information and what is deemed best for the overall economy, rather than being influenced by political pressures. This stance underscores the traditional role of a central bank, which is to maintain price stability and maximum employment, often requiring it to make unpopular decisions that are seen as necessary for long-term economic health. A significant factor complicating the Fed's decision-making process is the impact of trade policies, particularly the sweeping tariffs that have been a hallmark of the previous administration. Chair Powell and his colleagues have openly stated that the effects of these tariffs on inflation and the broader economy are uncertain. They have adopted a cautious approach, waiting to observe how these trade barriers translate into real economic consequences before making any adjustments to interest rates. The concern is that tariffs could potentially lead to higher inflation, a slowdown in economic growth, and even an increase in unemployment, creating a challenging environment for monetary policy. It's also important to contextualize the ADP report within the broader framework of jobs data. Many economists tend to view the ADP figure with a degree of skepticism as a sole predictor for the Labor Department's more comprehensive and closely watched jobs report, which includes both public and private sector gains. The Labor Department's data, often released a few days after ADP's, is compiled using different methodologies and typically offers a fuller picture. While the ADP report showed a significant slowdown, the upcoming Labor Department report is generally expected to show a more respectable, though still decelerated, job gain. This divergence highlights the nuances in interpreting economic indicators and the importance of looking at a range of data points. Beyond the immediate jobs numbers, there are broader concerns about the health of the labor market. The Labor Department's April report, for instance, indicated that the number of Americans who have been out of work for 6 months or longer reached 1.7 million, the highest in more than 2 years. This long-term unemployment figure is a critical indicator of economic distress, as it suggests a persistent challenge for a significant portion of the workforce to find re-employment, even as the overall unemployment rate remains relatively stable. Such details add layers of complexity to the seemingly straightforward debate about interest rates. Despite the intense public pressure, the Federal Reserve's Federal Open Market Committee, or FOMC, has maintained its benchmark short-term rate at a range of 4.25% to 4.5% for its third consecutive meeting. The general expectation among financial analysts is that the Fed is likely to hold rates steady at its upcoming meeting, scheduled for June 17th and 18th. This cautious approach reflects the Fed's need to see sustained evidence of economic trends rather than reacting to single data points, especially given their stated requirement for multiple poor readings before altering their interest rate decisions. The relationship between President Trump and Chair Powell has been tumultuous since Powell's nomination. While Trump elevated Powell to the Fed chairmanship during his first term, their views on monetary policy quickly diverged. Despite previous hints and discussions about firing Powell, the president stated in April that he had no intention of doing so. However, the question of whether a president even has the legal authority to fire a Fed chair remains a point of contention. Some Supreme Court justices have suggested that the Federal Reserve, being a uniquely structured quasi-private entity, might be distinct from other independent agencies, implying limitations on such executive power. This legal ambiguity further underscores the importance of the Fed's institutional independence. Comparing the U.S. monetary policy stance with that of other major economies provides an interesting contrast. As President Trump frequently points out, central banks in Europe have indeed moved to lower interest rates multiple times. The European Central Bank, for instance, is widely expected to implement another rate cut, marking its 8th such reduction since last June. This move in Europe is largely driven by easing inflation and tepid economic growth within the Eurozone, creating conditions that are more conducive to aggressive rate cuts. This divergence highlights how different economic conditions and policy frameworks can lead to varied monetary responses across the globe.
The overall economic outlook is characterized by increased uncertainty, with a heightened risk of what economists refer to as stagflation, a portmanteau of stagnation and inflation. This risk is amplified by geopolitical factors and the impact of tariffs, which can simultaneously dampen economic growth and push up prices. Chair Powell has articulated these concerns, noting that trade barriers could generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. This highlights the tightrope the Fed must walk, balancing the need to support employment with the imperative to control inflation, all while navigating external pressures like trade policy. In conclusion, the debate over interest rates, fueled by recent jobs data and political pressure, is a microcosm of the broader challenges facing the U.S. economy. The Federal Reserve, under Chair Powell, remains committed to its data-driven approach, resisting calls for immediate rate cuts while carefully assessing the long-term impact of economic factors, including trade policies. The divergence in economic performance across sectors, the distinction between different jobs reports, and the unique position of the Fed as an independent body all contribute to a complex picture. As we move forward, market watchers will be keenly focused on upcoming economic data, particularly the Labor Department's detailed jobs report and any further statements from the Federal Reserve to gauge the likely trajectory of monetary policy. The balancing act between political expectations and economic realities continues, and it is a fascinating, if sometimes contentious, process to observe. Thank you for tuning in to Financial Podcast. We appreciate your continued support and look forward to bringing you more in-depth analyses of the financial world. Until next time, stay informed and stay